All right, testing 1, 2, 3. See if anybody's out there. Ready to begin when you are. Just let me know you can hear me so I'm not wasting my time. That's the trick to this whole thing. We can get past that stage, we're in great shape. La da 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 da. Well, look, everything's popping higher. Very nice. Looks like the indexes are bouncing all of a sudden. People betting on the Fed to do whatever. I guess probably the rumor out that the Fed's only going to do the half a point. Maybe it'll do less than a half a point. That would be win. See, that would be wrong though. That would be a big mistake. They can't just immediately back down as soon as they start raising rates. Okay, people can hear me. Let's see. And now we try to do the video thing. See if you can see my screen. Then we can get this show on the road. Dun, 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 dun. I was actually super ready 15 minutes ago, but then, wait, what? Hold on. Gotta shove that over here somewhere. So I was ready 15 minutes ago, but then I got distracted by got a warning from my computer telling me I'm running out of storage space. And it turns out there's, oh, what was it called? Oh, it's not gonna do me any good if I can't remember what it was called. Oh, and I deleted it. It was some kind of Apple syncing thing. Anyway, I had, I had backed up my iPhone to my computer at one point, and ever since then, apparently, it's been automatically backing my iPhone up to my computer, and it was using 50-something gigabytes, which is crazy. So that was like all the data on Earth 20 years ago. So it was using 50-something gigabytes, and that was eating up a lot of my storage. It was pushing the computer over the edge on storage, because this is just my side computer that will work. This computer is just a side computer I use for the webinars. So I deleted it. Something sync, mobile sync. Shit, I'm sorry, I don't know what it was. Apple sync. Apple, I forgot now. So I feel bad. I was really trying to. It was whatever it was, though. It's like a handy hint. It turns out the thing never throws anything out. It just, if it makes a backup, keeps it, then makes another backup, keeps that, then makes another backup, keeps that. So it just keeps stacking the backups on top of each other, and it doesn't actually clear them out of the drive, and that's why it gets sort of full. So probably a lot of people can free up a lot of room by, doing that. Except mobile sync, I bet is what it's called. I don't know. Well, it was something that was wasting a huge amount of disk space anyway. So handy hint though. I mean, you can always go to the settings in your computer. You guys can see the screen now. So you go to settings on the computer. I bet some of you younger people don't even know how to do this stuff, because we used to have to do this all the time, and now it's like a dead thing because everything's so automated. So computer, system, and storage. There it is. And this thing tells you where you are. So you have 237 gigabytes. It's not like terrible, but it was literally like all the way at the end here with no room. So I just freed up 100 and something gigabytes by deleting just those files. See, I don't know what it was called now. It was an other. No, because I deleted it, so I don't know what it was. Sorry. It was a good housekeeping tip too. All right. Anyway, let's get this show started. Not there. Not there. Uh-oh. Uh-oh. Where's the talkie thing? There it is.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, nor its affiliates, nor any of their respective offices, personnel, or representatives Agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar, website, or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OC website. Trade characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any loss you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone.
All right, fantastic. So where are we? Okay. So as we noted, the market is bouncing a bit. Don't forget 4180. Is that right? 4180 is where we have to be on the S&P. Is it 80 or 60? Or I forgot the number. Let's take a look at today's post. 4180, yes, 4180. So 4180 is where the S&P has to be just to be at the weak bounce line. So there's nothing exciting really about hitting 4180, and we're at 4182 at the moment. Actually, this is 4175. I guess we were at 4182. So there's nothing impressive here, and obviously that's all goes for all the rest. So we you know, the 13.5 is the baseline for the Nasdaq. We're miles below that. Can't get over 19,000 here is terrible, and the Dow, you know, 35 really is where you got to be for the Dow. So, you know, this is nothing, everything is nothing. It's all noise, just waiting for the Fed to come on in an hour and tell us what's going on. Not even that, though. Then we got to wait for Bernanke for, I'm like a Fed chief behind, for two Fed chiefs behind. Then we got to wait for Powell to come on and talk. It's so confusing because Yellen's the Treasury Secretary now, and it's like, so you gotta, you know, she's still around, but she's not the same, she's just moved jobs. Anyway, so oh, hey, something did happen today. So last week, the last thing we talked about last week was we decided that we wanted to make a bet on I don't remember, Generac, right? We talked about Generac at the last meeting, and today they just had their earnings, and we just talked about it in chat. So, you know, the stuff we talked about at the in the webinar last week became a top trade alert at on Thursday. I sent out a top trade alert about the stuff that we had talked about in the webinar. We had a Boeing play, and I talked about the adjustments that we would make to the Boeing play. And then there's Generac, the generator company. And I basically turned what we were talking about here into a trade idea. And I said, well, you know, let's just start off simple. Let's just sell some puts in the earnings portfolio, because we have the earnings come up today, which look how nice they're going. So we have the earnings coming up today. And at the time I was like, because we were coming down sharply last week. It says, oh, these are weekly candles. Yeah, so last week we were here coming down. And, you know, and again, this goes back to the whole concept of what we do, right? We trade options. Now, one weird thing we do as options traders, though, unlike pretty much everybody else, is we don't buy options, we sell options. I mean, yes, we buy them, but let's, you know, technically, conceptually, we sell options, and more specifically, we sell option premium. We are cognizant of the premium of the options, and we sell as much of it as we can. So even when we're buying an option, we're usually only buying it in order to sell an option that has more premium against it. We don't buy options with premium. As a rule of thumb, we pretty much never do that. And so you know, when I get lumped in, like I got this, I'm doing a seminar in Vegas next week, and you know, they're trying to fit me into the agenda and say, well, isn't that guy talking about this, and isn't that guy talking about this? And basically, I'm trying to be nice about it, but I'm saying, no, those people are all wrong. They're telling people to buy options. And when you buy an option, you pay a premium. And the premium is just like the spread in football. Okay, the premium is designed so that you seem to have a reasonable bet, but because of the premium, you lose almost all the time. You know, when you gamble on football, you're not betting the Jets will win. The Jets have to win and cover the spread. And the spread is exactly the amount of points that the Jets are not likely to make more than. You know, and they have, you know, statisticians and all kinds of people doing it. And of course, they're not always wrong, but they're right often enough because they do it from a purely statistical standpoint. They're right often enough that you will lose most of the time, and most people will lose most of the time, and therefore it's a great business for the people taking the bets. You know, it's a terrible business for the people betting, and you know this because how many of your friends, when asked what they do for a living, say, "Oh, I'm a sports gambler." I mean, it's another thing. Unless you live at the track, there's probably not many people who do this for a living. And of course, the people who do it for a living live at the track because they don't have houses. You know, the most famous sports gambler in the world was Arnold Rothstein, and he was a cheat. He fixed the games. That's why he was good. That's why he's successful. But that sort of perpetuated the myth. He's the guy that fixed the World Series in 1909 or whatever, when the Black Sox, Chicago. It was really the White Sox. It was called the Black Sox scandal. So he bribed the Chicago White Sox to throw the World Series. 8 Men Out, I think, is a movie about that. So, you know, but that was just. That was what he got caught for. His whole career was based on fixing races, fixing sporting events, so on and so forth. You pay guys to take a dive, you throw off the odds, and then you win. It's not hard. You know, you just pay, you know, I mean, the most notorious bribes in sports are generally you just pay somebody not to play. You don't pay someone to cheat. You don't really pay athletes to cheat. They won't, you know, that's kind of a line you can't get them to cross, but you can get them to call in sick. And they're like, well, I'm just not going to play. The guy's going to pay me $1 million not to play. I won't play. You know, and now we've sort of turned the. Now, interestingly, we're now allowing all the sports betting everywhere, and I guarantee you, it's going to come back. That you're going to get more and more cheating will come back into sports now. Anyway, point is, that's all you're doing. Now, you can't pay companies generally to tank their earnings. Okay, so, but the spread is still there. So when you sell, so in other words, you know, but it's, you know, it's more like a horse race than a sports book, because the sports book, the odds are set by professional gamblers, whereas in a horse race, the odds are set by the other gamblers at the track. So that's called parimutuel wagering. And what that means is that the more money that's bet on something, the lower the odds go, and the less money it's bet, the less the odds go. So they're just trying to attract bets to all positions. And the stocks are like that too. If a lot of people are bidding on something and want it, the price goes up. You know, it gets higher until people stop wanting it. That's how they set the price. So it's set by the market more so than set by experts. There are formulas that give you the initial price of options, but that doesn't keep them where they're supposed to be. Then people decide if they want these options or not. So anyway, so the point of that, without getting into the weeds of that process, is, you know, we sell premium. So what are we selling here? As the stock was going down, and again, how do we pick a stock? We combine the stock selling, which I just hopefully explained is a very advantageous position for us to be in, because we're the bookies basically. So we combine premium selling with fundamental analysis. I'm a fundamentalist. More above everything else, nothing matters except, well, two things matter the most when I'm making a pick. Number one, are the fundamentals where I want them to be? So did Generac come down to a price where I would be willing to buy it, come hell or high water? So the answer last week we talked about it, and the thing was yes. You know, Generac is now at a point hitting $200 or getting close to $200 where I would feel bad if I missed getting in. All right. Now, we knew earnings were coming up. We don't like to bet on earnings, and I even talked about that last week. That we, you know, ahead of earnings, I don't like to make a big bet because you know you never know what's actually going to happen. And boy, could you see that today with some of these companies. But that's the thing. So even though the chart looked horrible last week, it was still at the alarm for me isn't the chart, because I could give two shits about what the TA looks like. What I care about is where's my target. And so even though it was up here at 225 or whatever it was, I said, let's sell 5 180 puts. So first of all, we're selling 5 puts that say we're willing to buy the stock for 180. But here's factor number 2, because somebody's willing to pay us 20 bucks or 18 bucks, which is 10% of the put cost for the 180 put. So in other words, I'm selling a put contract. That gives this guy the right. He's paying me $18 for the right to force me to buy his stock, Generac, for $180. So my price, if he decides to make me buy, and he can do this anytime between now and 2024, he can at any point say, Phil, you have to buy my Generac stock for 180 bucks. Now, of course, if it's over 180, he's not likely to do that. He can only sell it to me for 180. He can't sell it to me for 185. So it has to be 180 or less for this guy to even want to sell it to me. Meanwhile, though, I collected $18, so my net entry is 162. I already have it. I get the $18. He can't get that back. I already gave him something of value. The thing of value I gave him for $18 was the right over the next 2 years to sell me his stock for 180. That's all he bought from me. And he's either going to use it before it expires or he's not. And that means over the course of 2 years, I'm either going to own, in this case, 500 shares of Generac, or I'm not. Now, 500 shares at 180, or technically, you know, well, I have the money. Keep in mind, I have 9,000 in my pocket. He can force me to buy 500 shares for 180. That would be $90,000. $90,000. So it would really be $81,000 net of Generac stock. Now, of course, in a portfolio margin account, GNRC, in a portfolio margin account, if you 180 puts, that's interesting. They seem to be now more than they were last week, but it doesn't matter. Anyway, so sell single 5. Maybe it's because the VIX went up so much. Anyway, so we collected 9,000. Apparently they've gone up in price, even though, so we're right so far about the direction of it, but the VIX has increased the price. The volatility has gone up, therefore the price of these have increased. So we're currently losing money on these short puts, even though it totally went our way. Anyway, so the maximum loss, because we're collecting the money, maximum loss is about $80,000. But the buying power effect, that's the key. We're collecting 10,000 bucks or 9,000 bucks we collected. The buying power effect is only 4,600 bucks. Why is that? Because they're so far out of the money, and our cash makes it net 160 something, right? So they're so far out of the money that we that the calculation by the broker, which is generally based on a 20%, that, you know, they usually assume a 20% price drop for the stock. So 20% from 250 is still 200. It's still above where we are. So they're taking a very negligible amount of margin in a portfolio margin account against that position. So we get to put $9,000 in our pocket in exchange for a $4,500 hit to our margin. That's called a margin efficient trade. Whenever you have less margin being used in the amount of cash you collect, it's margin efficient. It doesn't stay that way, though, of course, if the market starts going lower, because when it starts going lower, you can get double hit, though. You always have to be aware of that. You can get hit on both the cost of the short put goes up, right? So you have a bigger charge against you in the portfolio, and the margin requirement increases as well, because you're closer to the point where you may have to be exercised. And if you're exercised, you need to have 90,000 bucks to cover. So, you know, you can't, just because the broker says you only need 4,000 in margin, doesn't mean you better not in your mind be segregating enough money to cover that. And that's all in our strategy section. There's an article about that. But you do have to mind that we have what we call allocation blocks that we set up to determine how much money we set aside for each trade. And of course, when a stock goes up a lot, like when this is now 250, when a stock goes up to 250, if it holds 250 for a month or so, we will effectively release, you know, I might have $45,000 set aside to buy $90,000 worth of Generac, because if we buy $90,000 worth of Generac, we'll have $45,000 in regular margin used for that. So we may release that allocation block of $45,000 if Generac tends to be holding up at 250 and starts moving higher from there, because it becomes extremely unlikely we're going to need that money for that purpose. So, you know, you have allocation blocks, you commit them, but after a point, you may not need them anymore. Now, meanwhile, had it gone lower, we would have been very happy to buy the long calls, because we still believe it would have gone lower for dumb reasons. We would have bought like the long calls, and let's say we bought the 200s that are $97, $98, and we sold the 250s for $70. So what do we say, 98 and 78? So that's $28 on a $50 spread. Then combine that with the $9 we collected short, and now we paid $18 for a $50 spread. That's the current price. Had it gone lower, we would have paid less money. We probably would have paid $16, $15 for it net, $15 for a $50 spread, and that would have then become our play. So instead of our outside being $9,000, our outside would have been $35,000. So we would have had a full position, but we would have had a much larger upside, making effectively the same bet that we made in the first place, that we didn't think it was going to go below 180. So, you know, we were almost hoping it would go lower. This is not a best case scenario for us, because now we're kind of like, I don't know if I want to chase it. We're probably not going to turn it into a full play. It'll probably just stay as short puts in the portfolio. Why? But the point about the short puts, it doesn't cost us any margin. It's not affecting our portfolio other than waiting for the clock to run out and collect the $9,000. That's what's great about the strategy. So basically, the strategy that we use primarily for engaging new positions, unless we think they're so cheap that we want to grab the whole thing now, is we first sell a put, then we see how it goes. And in this case, a week later, we have earnings and we see that they are doing exactly as well as we thought they would be doing. And then, you know, so if it goes well, we probably end up sticking with the put. If it doesn't go well, we start establishing, we layer into a full position. But the point being, we already sold the puts at a good discount. The stock goes down, and now we're going to get a great discount on the position, on the long position. But when I say a long position, remember I said we don't buy premium. What happens when I buy the 200 calls for 98? Well, they're at 250. So if I buy the 200 calls for 98, that means I'm paying $298, and the stock has to go above $298 for me to make any money. You know, forget the money from the short calls. So the stock has to go above $298 before I make a penny. To get my money back, it has to go to $300. That's why option buying is dumb. This stock has to go up 20% for me to make a penny. That's dumb. That's a stupid, stupid bet, but that's your spread. Now, well, how do we change that? Because what we do is we take the $200 stock for $98 and we sell the $250 calls for $70. All right, so now what happens? So now our net, instead of being 98, our net is 28. And that means we effectively paid $228 for the stock, right? Well, the stock's at $255. All of a sudden, we went from being idiots to being geniuses, right? We were going to pay $298, but instead we sold some other dummy more premium than we were paying. Because this guy, remember we paid net $298. The guy at $250 paying $70 is paying net $320. He's paying 10% more than we are. So he's 10% stupider than us, but the benefit is our net spread now is $28. 200 is below the current strike of 250, below the current price of 250. So we're in for net 228, even though the stock is at 255 now. Now you think that's crazy. Why is that so good? There has to be a downside. Yeah, the downside is that we can't make infinity money. Like if this stock goes to 600, we're capped at 250. We sold the other guy the right to 250. He's the one that gets the great big upside bonus if the stock flies higher. But we only, and only being in quotes, we only make a double. We make 100% back on our outlay. Not quite 100, 22 out of 28. But we make 100% on the outlay if the stock goes up to 300, if the stock goes up 20%. For this guy to make 100% on his outlay, because he's still, I'd say he's still 270. So for him to make 140 bucks, I'm sorry, 250. For him to make 150 bucks, the stock has to be at 390 or 400. So I make my money. I get a double at $200. He gets a double at $400. Okay, I don't need to win all the time. I'm sorry, 250, we get it at 250. I don't need to win all the time. I don't have to get every penny out of every move that's made. And that's what you have to learn, is to learn to let go. And it's the same thing at the casino. Okay? The Steve Wynn is not going to double his money in any given day. Because he's not playing that game. He's playing the game of betting against it. He's betting that most people will lose in very small incremental amounts. And that is predominantly true. And you know this. When you sit at a table game in Vegas, you play, you play, you play, you lose, you win, you lose, you win, you lose, you win, you lose. And after a few hours, basically you lost. And why does that happen? It happens because that's the way it's designed. The odds are against you. Even the teeniest, tiniest amount of odds against you grinds away at your money. You know, like I talked about this before, I don't want to make a big thing of it, but roulette is a very simple concept. Roulette's got hang on. Let's see who's got a good picture. Well, here's the odds of roulette. So a single number pays 35 to 1, right? The odds against, oh, that's convenient. The odds of winning are 36 to 1 because it has a 0. So in other words, here's a roulette wheel. It's got 35 numbers, but it has an extra 0. That 0 is the 36 number. But you're not getting paid for that. You're getting paid 35 to 1 for betting on a number. So what does that mean? That means every single time the odds are 1/35th against you. Okay, so there's one number on a wheel, 136 against you. So 1 divided by 36 is 2.7%. If there's a double 0, the odds are 5% against you every spin. So what does that mean? That means that over the long haul, every single spin is eating 2.7% of your money. Now, you might win. You might win a 35 bet, right? So if you have, well, I guess the easiest way to do it, if you have $350 to start, I don't know if it matters if you have $350 to start, but you have $350 to start, so you should get 10 wins. And well, we're not going to go that far. $35 to start. You have $35 to start. Not that it works this way, but you have $35 to start, and each time, what do we say that number was? 2.7%. So times 0.973, 3405. So yeah, you're losing $1 each time the wheel spins. Now, in theory, once every 35 times, you should win. If you win, it resets. And you're a happy little camper. Oh, I know what the floor is. The floor is you can't bet $1. That's the problem. Ah, there you go. That's what the problem is. That's why there's minimum bets. So the minimum bet is $5, 5 times 35, or 10 times usually. Well, let's say it's $5 on roulette. So 5 times 35 is $175. So you can't start with $35. You have to start with $175. But the problem is you're still losing 0.973, right? You're still losing, except now you're losing $5 per bet. You know, so you have a very good chance of losing all your money before you win. You've got to win before you use up your money. Even if you do win, though, what are you going to do? You keep playing. And the worst thing people do is they spread their bets around. Let's bet on this one. Let's bet on this one. Let's bet on this one. Well, think about that. You know, people are weird. And that's because people can't do math for the most part. You know, the human brain's not really designed to think this way. And most people, you might understand math, but you don't think of the total statistical environment that you're playing in. So in other words, if I'm a Jet fan and I want to bet on the Jets to win, I don't also bet on the Cowboys to win if the Jets are playing the Cowboys. All right, so forget the spreads. If it's an even bet, I don't bet on the Jets and the Cowboys to win. I certainly don't bet on the Jets and the Cowboys and the Giants, because the Giants aren't even playing this game. Yet, when you spin a roulette wheel, people have all these strategies that involve betting on other numbers than the number that they actually think is going to come in. And obviously, you're going to lose. And the more you bet, the more chips you put on the table. Each one of those chips will lose 2.7% of its value. Will get 2.7% less back than the bet. So the more times you bet 4 chips, you're going to get 10% less back. And that's what happens to your money when you play roulette. That's what happens to your money when you play blackjack, and that's what happens when you play craps. That's what happens when you play every game at the casino. Every game is designed this exact way. Nothing pays what you think it pays. Nothing pays you back as much as the statistics say you're going to lose. And the casino operator is only betting on math. And when I say only, you know, you think about how many people go to Las Vegas, but not many of them have a building the size of Steve Wynn, right? Or buildings, because that's the way it works. The system works. The patient grind, and also that's another thing you see. You see these casino guys. Once they get one casino, they get one, then they buy another, then they buy another, and then they buy another. Why? Because that's what happens. The statistics work. They work consistently over time. It is possible to have a bad luck streak as a casino and lose, but unlikely. And that's also why you have to manage your reserves and so on and so forth in a casino. You can't just assume you're going to win all the time. You could have a bad month. You can have a bad week. You can have a bad month. You can have a bad year. But over time, statistically, it's almost impossible for you to keep losing. And the more people who play more money on more tables and more games, and the more diversity of games, it allows you to hedge your own bets so that you're pretty guaranteed people are going to lose. So that goes back to, what do? We take a lot of bets. We sell a ton of premium in our portfolios, and we collect it, most notably in our butterfly portfolio. So the long-term portfolio is back to 300%, which is what, like 26,000 up today, and it was up 50,000 yesterday. So I mean, it's been cranks out money when it's going well. But we sell, and that's what I mean by selling premium. This is what we do. These are our short puts. Okay. If we buy a stock, when you buy a stock, you're paying 0 premium. Then we sell a call against the stock. Then we sell a put against the stock. So we're promising to buy the stock. If it gets cheaper, we're saying we'll buy more of it. And you see here, we sold the $12 puts for $2.50. And CIM has gone down since then. It's gone down 15% since we bought it. Isn't that handy? We can see right there. It's gone down 15% since we bought it. So it's now 1071, 10.71 times 1.154. So it was 1235 when we bought it. Oh, well, I should say that right here. Oh, 1265. Haha. Oh, I see. Because negative 15% from 1265 is more than going up the other way. So it's gone down from 1265. But what did we do when we bought it for 1265? We collected $3 for the 10 calls. So we didn't think it was going to go. We didn't think it was going to go much higher. So we already took this as a bet where we sold the 10 calls for $3. That dropped our net to $9.65, right? And that means at $10 we make a whole 35 cents. We're in this one for the dividend, not for the stock. But we also sold the $12 put. So we said we'll buy more if it goes lower, but lower wasn't really 12. It's 12 minus 250. It's 950. So we're paying net 950 for another 2,000 shares, not even 3,000 shares. We're paying net 950 for 2,000 shares. So we end up paying net 37,950 minus 14,000 divided by 3,000 shares. We paid $7.98 for the stock. That was our net cost of the stock. We get called away at 10 in January, and basically it's over 10 now. So we get called away at 10. We have a $2 profit on the stock. And that's 2 of 798. So 2 divided by 8 is 25%, obviously. 2 divided by 8. Well, 2 divided by 8. There, 25%. So we have a 25% profit if we're called away. And that's over basically 2 years. It's from April last year, plus the dividends we collect, which is substantial. Chimera pays about 10% dividends. So we get 25 plus 10% is 35% from last year, another 10% this year, 45%. So basically, this play is designed to make us 45%. Now, whatever the price of CIM is, we can get assigned another batch of 12. We paid 12 for the first batch. And what are we going to do if we get assigned? We're going to just sell more puts and calls. And we already made whatever that number was for the 25. I'm sorry, we made 25, 35, 45 percent. So we make 45% of $37,000, which is like $14,000. So we're going to make $14,000, and that goes towards buying the next round of stock. And we don't have to buy as much. We only have to buy 2,000 shares in the next round. Then we sell more puts and calls and repeat the cycle. And eventually what happens? Eventually we own the stock for free, and then it's all gravy. And that eventually comes very quickly on the stock, which is why I love it. That's why in fact, that's why I think there's maybe like 2 actual stocks in the long-term portfolio. Yep, Plains America is the other one, a pipeline company. So we only have 2 actual stocks in the entire long-term portfolio. The rest of them are these artificial plays where we buy the long call and we sell the premium to some other sucker. We don't pay premium. We sell premium. All these put positions, we sell premium. I promise to buy this stock for this price minus that price, minus what I sell it for. Now, as we've said, these short puts can get dangerous when the market starts dropping. Here's Coinbase. We sold a $200 put for 45 bucks. That seemed like a great idea at the time, right? But now the stock's at 120. Our net is 155. Thank God we didn't actually buy the stock for $100,000, because now we'd be down, whatever, half of that money, basically. So instead, we're down a quarter of that money. We're down $24,000, but we're going to roll these into something else. But and also I think Coinbase is way oversold, so I'm not too worried. I'm actually not too worried about it, even though it's down 100% from where we started. When the 2025s come out, we're going to roll it. That's all. We're going to stick with it and see if it works itself out. Anybody else in big trouble? Netflix is in big trouble. We sold some puts there. We sold the 350 puts for 50 bucks, so that's net $200. I'm sorry, net $300, not 200. And it's the same thing. We're going to have to let them work themselves out. So these are big hits. 50,000 here, 24,000 here, 26,000 on Wayfair. We've talked about Wayfair enough, so you guys don't need to hear it again. We can't believe how bad they are. And what pisses me off, it started out as a short play. So we were short. We made plenty of money on the shorts to cover this, but it's annoying that these stupid short puts, we can't get out of them because they keep dropping. I don't know if Wayfair had earnings yet, but I mean, I think this is oversold. We talked about that, obviously, but I just don't get it. So did they have their earnings yet? Nope, earnings preview. So it must be like coming up. So are they actually this bad? This is the question with Wayfair. Are they really this bad? And that bad would be this. I mean, again, we shorted it here. So we made a ton of money shorting it. But then what happened is when we got out, we said, well, we'll wait for these puts to bounce back before we get out, but they've actually gone much worse. I still think that this is oversold. I think 150 is probably closer to the right price. Not the 150 is even that. I'm not sure that's helpful enough. Yeah, we sold the 170 put, so I don't mind paying 20, 30 bucks to buy them back, but I'm not going to pay 80 bucks. That's crazy. So hopefully they recover somewhat. But even with all those hits, the long-term portfolio is at basically $2 million from a $500,000 start. We started with $500,000 on October 1st, 2019. So it's 2.5 years now. And we were, by the way, at one point up to 2.5 million, or maybe 2.3, whatever. But this has, this hit in the market recently has really hurt us, especially with crap like this. Especially those kind of things. Also, we have some big hitters, but we talked about this last week. Moderna is killing us right now, but we love them. Things like that. Let's see if we have any questions before I got 15 minutes to the Fed. Nobody has any questions, so I can just keep rambling on about stuff. All right. So back to what is this? This is that's today. Oh yeah, so that's what we talked about. Now, as far as the bouncing or whatever, and where the stocks are, how are we looking right now? Ooh, look at Generac, 10% today. So, a lot of this was baked in. The Fed, obviously, people have been listening, and the market has gone down. This is the S&P. So in the last month based, is this a month? Yeah. Well, that would be a month, right? See, that's funny. Because if you think about it, in the last 2 months, this is 2 months. In the last 2 months, we're in the same place. This is where we were 2 months ago. This is where we are now. No change. The problem is, though, that it's more likely we're consolidating for a move lower. See this spike? Spikes usually telegraph something. And, you know, when you see something like that, this flash crash, it's usually, the problem is, the fact, even though it went down very briefly, let's see if we can get a zoom on that. Okay, so even though this is what that flash was, so even though it went down there really briefly, it still shows you that there weren't all this thing, there weren't any buyers. Somebody flipped a button and hit a buy program here, but those orders were not in place here. Otherwise, the stock never would have done that. The index wouldn't have done that, right? So somebody big, that's what this is. Somebody big hits this level and says, "Uh-oh, we better start buying." Now, that's somebody big. Sometimes it's the Fed. You know, other times it's Goldman Sachs or JP Morgan who don't want to be wrong. They didn't warn their clients that the market was going to crash today. So therefore, they don't want to be wrong. So what they do is they reverse it, and they reverse it by buying a couple of $1 billion worth of stock. Because for them, think about Goldman Sachs, okay? For them, they're going to make their money back on the stocks. And in fact, you do, because obviously if they're buying and buying and buying to save the market, right? And it gets back up to here, and then they sell off all the stuff that they bought that they didn't really want. They didn't lose any money. They made money. They caused the rally, but then they sell into what they've done, and they fixed everything. So they got their money back. They made a profit, and they look like geniuses. Compare that to having their reputation damaged because they weren't able to see something happening. They don't like that. So, you know, what they'll do is when the market starts going down, the broker, it could be a brokerage, it could be any of those guys, but it could be a large brokerage, it could be a couple of brokerages. They could get on the phone and call each other and say, let's all buy and stop this from going down any further, which, you know, absolutely happened all the time in 2008 and 2009. There was collusion with the Fed, the big banks, the government. I mean, it wasn't even a secret. You saw them having meetings and talking about what are we going to do to save the market? What should we do here? It's like, what are we going to commit to? What are you going to do if we give you this much money? You know, they would flat out say to JP Morgan, here, we'll give you this much money. What are you going to do with it to save the market? Oh, well, we'll start by buying, you know, we'll start by buying this bank's assets, and we'll do that. And we'll make this announcement. And we'll buy this stock, and we'll do that. And we'll tell everybody that we're buying GM here, and we're buying Chrysler here. That's the deal. That's how it works. It's a big, giant, fixed game. But who cares? I haven't said this in a while because that's an important thing to understand. So, okay, we don't care if it's a rigged game as long as we understand how the rigging works and we're allowed to bet alongside them. And that's what I'm talking about when I talk about selling premium and options. We're allowed to do exactly what JP Morgan does. We can do the same taking advantage, okay? When a stock crashes on us like this, we get to sell huge amounts of premium. You know, we made quite a few calls in the last 2 weeks because I love it when the VIX, the volatility index, when the VIX is up here towards 30 and you get to sell premium, you're selling incredible amounts of premium. It's ridiculous. All right, it's like betting on a football team and giving you tell the other guy he's got to win by 40 points to win his bet. It's like, that's not going to happen. That almost never happens. So it's not enough for him to win. He's got to win by a huge amount. Just like the guy we sell the Moderna calls to, right? He doesn't have to. He doesn't have to get to 270. We're 255 now. We sell him the 270 calls, but getting the 270 doesn't help him at all because he paid $70 for those freaking things. Well, the 250 calls, whatever it was, 250 calls. So the 250 calls, he paid $70 for those. It has to get to 320 just for him to break even. That's ridiculous. Can it happen? Yeah, I guess it could happen, of course. And I'm not, again, we're bullish on Moderna, but I'm not going to be bullish and bet on it going up 20% if I don't have to, and I don't have to. I can make more money from Moderna going up $25, going up 5%, 10%, sorry, 10%, going up 10%. Right, we'd have to go up 30% because Moderna, all right, wait, let's try and get that straight. Are we still there? Oh, Generac, it wasn't Moderna, it was Generac, sorry. So Generac's at 255 now. For Generac to get to $300, it has to go up 20% from where it is right now, right? But we're selling the 250 calls for $70. It has to get to 320, not 20%. So it has to go up another 20% is 300. I'm sorry, yeah, 20% is 300, and 320 is another 2/3 of. No, it's another 20. It's another 20 out of 250. It's almost another 10%. So let's call it 27%. Right, not 30%. Let's say it's got to go up 27%. So for this guy to get his money back, it's got to go up 27%. I forgot it was at 250. I was thinking like at 215. It's at 250. Our bet is it doesn't go lower. We're buying these guys for $98. We're selling the 250 calls for $70. So that's $28. So we're buying the 200 calls that are $50 in the money, selling the $50 calls that are $5 in the money, and we collect $50 back if Moderna simply isn't lower than it is right now. Moderna, I'm sorry, Generac. If Generac simply isn't lower than it is right now. That's a good bet. There's not no premium in it. There's negative premium. It can drop $5. We still get paid. I mean, we get paid for anything. I mean, our break even is down at 220 something. 228 in fact. So our break even is 228, not counting the short puts. We're also combining that with selling these puts for $20. If we pay $28 for the spread and we sell these puts for $20, our net is $8 on the $50 spread. And our break even is now 208, which is $45 below the current price. So now it has to drop more than 20% for us to lose money. And it doesn't have to go up at all for us to make 100% of our planned money. And it has to, and anything above that is just who cares? We don't care what it is. And so yeah, we're not going to hit any major home runs here. We aren't going to triple our money. It's impossible. We sold the right to triple our money. We capped our gains at $50. Excuse me. So we capped our gains at $50, but the chances of us winning is substantially higher. Substantially. Okay, because let me write this down somewhere. Yeah, quickly get some space. I guess you can write it on PhilStockWorld. All right. So in other words, I'm going to write GNRC so I can remember not to call it call it Moderna. Anyway, so GNRC. So the guy buys buying the $250 call for was it $70, right? So A, 320 is break even. All right. Well, actually, that's not A. 320 is break even. Okay, so stock goes down, lose. Stock goes up, stock stays flat. GNR fee 255. Let's keep that in mind too. 255. Stock goes down, lose. Stock stays flat, lose. Stock goes up 20%, lose. Okay. Now, see if we can do this. All right, so that's dummy number one. That's what his trade is. The guy who's buying premium, that's what happens to him. Now, 200 call for $98. Sell 250 call for $70. All right, and then I'm going to say that, then 228. Well, 228 is break even. This is not counting selling the put. So stock goes down. It has to go down from 255 is what, $27, right? Yeah. So stock goes down $27 at 10%. Break even. Stock flat. Win $22, which is $22 divided by 28 that we started with, 78%. Stock up, win $22. So that's without selling puts. Selling puts really only helps other than you're obligating yourself to actually buy. You're making a different kind of play. You have to really believe in the stock to do that. You know, same with this guy. This guy's doesn't necessarily believe in the stock. He's not buying the stock, but he has no obligation. So I'm comparing apples to apples. But the point being, you win $22 in 2 out of 3 situations. You only lose if the stock drops more than 10%. This guy loses unless the stock is up more than 20%. You guys have a 30% spread on your bet. You have 30% more to play with than this guy does. Okay, you could go down 10%, doesn't hurt you. Up 10, up anything, up a penny, doesn't matter. As long as it's not down $5, you win all the money you planned on winning, 22%. You don't lose money unless the stock is down more than 10%. You have, it's not even, I mean, not even quantifiable. That's you being the house, because you have so many chances. If it's a roulette wheel, right, you win on you win on the vast majority of the numbers. He loses on almost everything except for one lucky number. He has to hit that one lucky number where the stock goes up more than 20% and he's going to win. So the odds are vastly in your favor. It might be less money, but you're going to collect it much, much more often. And that's what our whole strategy is based on. And unlike a casino, this is the thing. See, we're not just playing the statistical option game. We combine that with our analysis, our fundamental analysis, so that we pick stocks that are very likely to go up. And again, we're talking about 78%. Is that the right number? Yeah, we're talking about winning 78% in 2 years, not some small amount of money. So we have tremendous leverage in what we're doing. And by the way, it's even more so because we will sell those puts. And if we sell the puts, what happens? So it's this, right? It's still that and sell 180 puts for 18. All right, so now the break even is, well, 228 is 210. So right, so now it's 210 break even. So it's the same thing, except the stock now has to go down 40, well, nope, has to go down to 210. Yeah, so it's 45 divided by 255. So the stock has to drop 17%. Stock goes down 17%, break even. Stock flat, win $40. See how it makes a big change, right? So stock flat, win $40. Stock up, win $40. And $40 against 10 is now 400%. And that's why we have such ridiculous gains in the portfolio, because we don't settle for 78%. We get these 400% turnovers. And don't forget that our our margin requirement for these is actually very low. So all we're doing for this trade to make, did we do it on that one? Oh, I erased it. Who is this? Sell 5 Generac. Still Generac? Yeah. So sell 5 Generac 180 puts. And we said that was 4,000 some odd, 4,600 in margin. But here we're selling 5, right? So, all right. So this one, the other one has no margin. This one has $4,600 in margin for 5. And that's equals or $20,000 in gains, in potential gains. Okay, so we're putting down $4,600 of margin. We collect $20,000 in gains if these things happen. If the stock doesn't go down 17%, we break even. If the stock goes down more than 17%, and it actually has to go down even further than that. Where's 180? 75 divided, so it has to go down $75 divided by 255, 29%. So stock has to drop 30% before we are forced to buy it. All right. Oh, the Fed. Okay. Anyway, so the stock has to drop 30% before we're forced to buy it in that situation. So anything other than the stock dropping 30% really isn't a problem for us. And yes, there's some loss of cash at the thing, but we'd adjust it, and so let's not get into that. But the point is, we're not forced to buy any stock at all unless it goes down 30%, in which case we're buying Generac for a 30% discount. So as long as we want to buy Generac for a 30% discount from where it is today, there's not really any substantial risk to this thing, is there? And yet we can make 400% back on the cash we lay out. And that's how we make those plays. That's why they're successful. And that's why we have these outrageous returns in our portfolios, because in a flat or up market, or even a slightly down market, we're going to make money. That's like betting on 3/4 of a roulette wheel and winning every time those numbers come up. We win most of the time. It's hard for us to lose because we set up our trades that way. We set up our trades so losing is very, very unlikely. That is the key to our success. All right, the Fed. What have they done? Oh my gosh, look at that. Apparently did something made people happy. All right, let's see. Who's going to tell me? Who's going to tell me what happened? FOMC meeting. That. Here it is. So exciting. May. What have you done? They raised the federal funds rate to 3/4 to 1%. So it was, I don't know. Did they only raise it 1/4 point? God damn it. Was it 1/2 point? I'm confused. WSJ. What the frick just happened? 1/2 point. Okay, they're calling it 1/2 point. So the markets are happy by that. It's really still so low though. It's like it's so language-wise. What are we saying here? See, they're still saying they're calling. See, I don't see how you call that 1/2 point raise. They started at 1/4, right? We were at 1/4 point, or was it 0 to 1/4? Ah, that's what it was. We were at 0 to 0.25. No one ever called that 0.25. That's the problem. We were at 0 to 0.25. They raised the rates 1/4 point at the last meeting, which made it 0.25 to 0.5. Now they've raised it 1/2 point. Now it's 3.5 to, or I'm sorry, it's 0.75 to 1. But still, when you think about it, that's pretty crazy. So this is so they've done the least possible that they could do. Overall economic activity edged down in the first quarter. Household spending and business investing remain strong. Job gains have been robust in recent months, and the unemployment rate has declined substantially. Inflation remains elevated. So that's interesting. Unemployment has declined substantially. That means the jobs report should be pretty good on Friday. Inflation remains elevated, reflecting supply-demand imbalances related to pandemic, energy prices, and broader price pressures. The invasion of Ukraine is causing human and economic hardship. The implications to the economy are uncertain. The invasion and related events are creating additional upward pressure and are likely to weigh on economic activity. In addition, COVID-related lockdowns in China. The committee is attentive to inflation risks. That doesn't sound. That sounds like they're See, I think people are misinterpreting this because they're not saying they're attentive to economic risks. They're attentive to inflation risks. These kind of economic risks are causing inflation. It's not going to make the Fed less likely to continue to raise. The committee seeks to do maximum unemployment, blah, 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 appropriate firming the stance, blah, blah, blah. Okay, the committee expects inflation to return to its 2% objective and the labor market to remain strong. When? In support of these goals, they're raising the target range to 1%. They anticipate ongoing increases in the target range will be appropriate. In addition, the committee decided to begin reducing its holding of treasuries and agency securities as described in the plans for reduces. They're going according to the plan that they gave out ages ago. In assessing the appropriate stance, the committee will continue to monitor the implications of incoming information. Committee would be prepared to adjust the stance of policy as appropriate if risks emerge that could impede the attainment of their goal. But their goal is inflation. Their goal is not to make the economy better. They're not saying that. They're not saying we're worried about the economy. They're worried about inflation. They're not even worried about jobs. The committee's assessment will take into account a wide range of information, including public health, labor market conditions, inflation pressures, inflation expectations, and financial international developments. Voting for it were everybody. Everybody voted for this. No dissensions. So nobody even dissented and said, I think it should be higher. And I'm telling you, that was because of the GDP being negative. Everybody's like, okay, half a point. We'll do half a point to this meeting. And as I pointed out yesterday, okay, we had 6 meetings left. Now we have 5 meetings left, but 6 meetings times 0.05 is 3. 3% is more than they were targeting. They were targeting about 2.5%. So they don't even have to raise 0.5% at every meeting to hit their goal. They could skip a meeting. Skipping a meeting now would be a bad idea, but if they feel in any way, shape, or form that they need to, they can skip a meeting. So it's another reason we're still holding on to our portfolio longs is because the Fed could pause and skip a meeting. And their meeting calendar, so they meet again in June, which is soon. So in 1 month they meet again. If the economy turns out, if these earnings keep going badly and the market keeps selling off, the Fed can start telling you that in June they're inclined to pause and see what happens, or they're only going to hike a quarter point or whatever. There's many ways they can make the markets happy by just talking about like easing off a little bit, because they can skip an entire meeting and still be okay. So even if they only raise a quarter point in June, that's still going to make people happy. They could do, so that means that they could do a quarter point in June, they could do a quarter point in July. And again, we still don't think the market's, we still would like to see the market get back on track or whatever. That would buy them all the way until September. So June, July, August, and September, that's 4 months. So they can buy themselves 4 months of being easy again and still be on track for half points. Now, they wouldn't like to. They certainly don't want to do a half point hike right into Christmas. So ideally, what they'd like to do is they'd like to get away with a half point here and a half point here, and then they can be nice on one of these and give us a boost into the end of the year. But now they set the bar, so anything under anything that's like a half point or less, people are now saying, oh, that's not so bad. And it's not, it really isn't, except that things like the mortgage rates, because you're buying a 30-year mortgage. So of course, it's not like the banks are being mean, but it's also not fair. But if you're buying a 30-year mortgage, the bank's got to look at the rate they expect to be getting over the next 30 years, not the rate that is now. They've got to average out like what's going to be expected over 30 years on their borrowing profile. Banks don't borrow money for 30 years. They borrow money for 2 years, 10 years, 5 years. They don't borrow for 30 years. So they've got to go by their expectations of interest paid to give you that money. And the Fed funds rate is an important part of that. So the Fed is telling the bank, we're raising rates to 2.5%, probably 3.5 to 4% next year. The bank's got to make at least a point and a half on the spread. So the bank's going to raise the rates to 5% because they're being told by the Fed that's what it's going to be. 1 year out of 29, they're going to get to borrow for a lower price, but after that, it's going to be back at the higher price. So, it's not really that the banks are doing anything evil, but the problem is that while this is happening this year, they are making a fortune on the spread, because right now they're still borrowing at 1% and they're selling you 5% mortgages. That's ridiculous. That should be illegal, frankly. But you know what that does? That causes more people. I don't want to say force, but it causes more people to take adjustable rate mortgages, because what's an adjustable rate mortgage says? It says I will go by the Fed funds rate plus 1.5%, basically. Whatever the Fed fund rate is, I will pay that mortgage, and it will adjust every so often to reflect the Fed funds rate plus a certain percentage. That protects the bank, so they're always going to make their spread. But the problem is, unfortunately, if the Fed funds rate for some reason goes up to 12, 13, 14%, you are screwed as the mortgage holder. So it's a huge gamble. That's what actually tanked us in 2008, 2009. Those variable rate mortgages were killing people. So many people had lines of credit and variable rate mortgages at those kind of levels, and when the rates started going up on them, they couldn't refinance because of exactly what happens now. The 30 years have kicked up to 5%. Even if you have a variable mortgage right now, your variable mortgage is probably at 3.5% or less. And that's the weird situation we're in now. You got a variable mortgage, even though you know you're going to get screwed on your variable mortgage as the Fed keeps raising prices. To go from your 3.5% mortgage to a 5% mortgage seems really stupid, right? You're going to increase your loan payments by your interest payments by 50% to go to a fixed mortgage. That doesn't seem right. But the problem is you're in an environment where for a fact you're being told by the Fed. But of course, you say for a fact, I say for a fact. It's for a fact to me because they don't have a choice. The Fed, the Fed can influence rates, and in a flat market, the Fed can influence rates the way you can steer a boat. If you have an oar, you can steer a boat pretty good in a calm river, okay? But if you're in the rapids and all you have is a freaking oar and you don't have a motor, you're going to have a hard time telling the boat where to go. It's going to pretty much go whichever way the water is rushing to. That's what the Fed is, okay? The Fed is great when it's calm. They can have this illusion of having total control over their boat because they do, because there's nothing else influencing it. But when things start going haywire, like Greece back in whenever the hell that was, 2009, when things start going haywire, there are other factors involved, like people no longer want to lend the government money at this percentage. Doesn't matter what the Fed sets a rate at. If the government tries to auction off bonds and nobody wants them, the Fed rate doesn't mean crap. And especially if the Fed's not the ones buying. That's been the thing. The Fed has been stepping in and buying hundreds of billions of dollars of bonds every month. But what happens when the bond rates start going up and the Fed's not buying and other people don't buy? Then the government has to. It's an auction. The government has to offer a higher rate until the bonds are sold because it's a debt obligation we already have. We already have the debt obligation. To avoid a default, we have to roll over the bonds. If we go into default, then the future auctions will be out of control. So at the auction, every time we have to sell exactly as many bonds as we're offering. And the amount of bonds we're offering is insane. It's about $250 billion a month of bonds are being sold by the government. And the Fed has been buying half of them, at least half of them, for decades. Now the Fed is going to stop buying them. Not all at once, but gradually pulling out. But the Fed's going to stop buying them. Who's going to come in and buy them? Especially when they're still below market rates, especially when a mortgage, this is the thing. There's a safety factor, right, to it. People believe that a bond is the same as cash, so there's a safety factor. But a bond is not, it's not really cash. And what bondholders are getting, obviously very slapped in the face over now is that bonds lose money in a rising rate market. Your bond loses value. So, people have expected their bonds to be flat or go up and always be this because the Fed has been just constantly lowering rates. I don't know how long this will go if I make it bigger. Here you go. Look, this is 2000. This is 20 years. This is what bondholders have expected for 20 years. Okay, yeah, there were some drops, just like the market had some drops, right? But you don't expect your stocks to go down. It's the same thing for bond investors. They don't, there have been some dips, but they washed out and everything recovered. Every time, everything recovers. They don't expect this to happen. 140 to 120? That's 15%. They do not expect their bonds to go down 15%. What does it mean? It means, now, you put $100,000 into a bond and you will get your 2% interest, right? Or your 3% interest, let's say 3%. you'll get your 3% interest. And at the end of 10 years, you will get your $100,000 back. That was the agreement you made with the government. They're not going to default on that. But the problem is that the present value, due to the inflation and due to the fact that if anybody wants to get a bond now, they're going to get a higher rate than you got. So the present cash out value for your bond, if you want to get out of it now, is now 15% less. It's $85,000. You've lost $15,000. And the reality of inflation plus your low interest is you have lost $15,000 because you're getting paid back in less valuable interest. You're getting paid at the end in less valuable cash. So if you want to escape now and get away from that obligation, not obligation, get away from the loan you made to the government, you will have to take a 15% haircut, because people who are skilled at valuing these things look at you and say, okay, you know what, your bond, I mean, I don't want that. Who wants that? I certainly not going to give you $100,000 to get 3% interest for 10 years. Oh, sorry, no water. So they're not going to give you the face value of your bond. Your bond is worth less. You can keep it and you won't lose money, which is, by the way, what the Fed is doing, because the Fed has trillions of dollars worth of bonds that have lost 15%, just like you have if you were buying at the highs. And the Fed bought trillions of dollars worth of bonds at the highs. So the Fed has, they've got these losses too, but the Fed's not going to cash out. The Fed gets to keep those on their balance sheet until they mature out. So the Fed will not take a loss on paper. And the Fed doesn't really give a shit about the money. It's not like they're going out to buy something. They weren't going to take the kids to Disneyland. You know, they weren't going to take the little banks to Disneyland or something like that. The Fed simply books it as a profit. They book the interest that comes in as a profit. All right, so they keep showing that this is a good transaction, even though any rational person will tell you it wasn't a good transaction. But it doesn't matter, because the Fed doesn't live in the real world. The Fed basically, they create the money, they put the money into the bond, they get the money back, and then they uncreate it. They take it off their balance sheet and uncreate the money so that it's retired, basically. But all in all, the Fed basically made the interest money out of nothing. So the Fed balance sheet, it's like a checkbook with an overdraft, right? So the Fed balance sheet is whatever it is. That's how much money they owe. But that is balanced by the assets that they purchase. So the asset they purchase is a bond. So the Fed writes an overdraft check where they pay no interest to create this money. They write an overdraft check for $1 trillion. They buy $1 trillion worth of bonds. The bonds pay them 3% interest, which is, I don't even know, it's some huge amount of money. It's $30 billion a year. So they collect $30 billion a year off of nothing. That $30 billion a year goes into the Treasury Department at the end of the year and is considered revenues. Okay, it's revenues from the Fed, but the Fed created the money out of nothing, bought bonds with it, took the bonds off the market. Remember, I said, who's going to buy the bonds? Fed takes the bonds off the market. The government declares that they've got money for their debt, and they do. They got money for their debt, but they still owe money for the bond that the Fed obviously took out. That's a new debt. The old debt gets retired. The Fed collects $30 billion a year for 10 years. Is $300 billion in interest on that bond, and that's all considered profit. And then they get their $1 trillion back, and they close their books. They close the balance sheets, and they retire that $1 trillion. It's basically a loan that they never had to pay interest on. And somehow that all bullshits into a profit for the government. It's total crap, but that's the way the system works. But now the Fed is saying we can't, our balance sheet now, though, has become too ridiculous. Our balance sheet is $10 trillion or something like that. And that doesn't make any sense. If the Fed's balance sheet can't be the second biggest balance sheet in the world compared to the US, where they are basically number 2. The most in-debt country in the world is the US, followed by the Fed's balance sheet. That's the second most indebted thing in the world. So if they lose their credibility, then they won't be able to play all these games that they play where nobody asks any questions. All of a sudden, all this stuff will come under scrutiny. They don't want that. So they play this game. All right. But what's going to happen is, and so at this point, though, the Fed can no longer credibly keep buying and keep adding to their balance sheet. And they've got to stop. And the government's going to have to find some other way to get to sell their debt. And they don't have a plan. You know, there's no plan. There's no plan at all. Okay, this is just they're hoping it goes well. That's effectively the plan. They're hoping things turn around. So that's where we are. And now Biden's going to speak in a few minutes. And let me see if I can find my remote. There it is. La la la. And TV go on. Did I say Biden again? Damn it. Damn it, brain. Update in progress. Oh. Update completed. Oh, that wasn't so bad. I never watched TV here. Let's see. What do we say? I'm gonna look for. I don't know. Oh, there we go. Bloomberg. Because we know those two guys. All right. Anyway, commercials. Ugh. So what else? All right. So that's that. How's the market taking things? You see, they spiked up, but it's not that great. It's a Dow. And as I said this morning, this is the only catalyst we got. If they can't make a move up on this, they're in big trouble because I don't see any other catalyst coming. This was the good news that the market hoped for. But this is a not a very exciting reaction so far. Got to wait for Powell, though. Powell's pretty good at the spin stuff. Let's see. Okay, let's see. New banning, tank busting javelins, Biden urges enshrining Roe into law. It's never going to happen. Ukraine, latest Biden praises impact of javelins, blah, blah, blah. Russian dodges, default for now. Oh, see, Russia's not defaulting. Dizzying pre-Fed day ends with gains for stocks, market wrap. How can they have a market wrap when you start? So the Dow's up 250, the S&P's up 25, which is basically they're up half a point. The NASDAQ is up 20, which is pretty much flat. All right, let's see what Powell has to say. Bitcoin's at 30, just under 39,000. The cryptocurrencies liked it. See, everybody's happy the rates aren't those 75 up. Because it's still a ridiculously, unrealistically low rate. But the problem is, though, here's the thing. The problem is we have a low rate at the Fed, but now the lenders aren't lending at these low rates anymore because they've been told that this low rate is going to be climbing all year long. So they're not willing to lend. And that means that the economy that was benefiting from low rates is already not benefiting, even though the Fed is only very slowly easing into it. The only people this benefits, surprise, surprise, is the banks. Because who is the Fed? The Fed is a bank. The Fed is all the Fed is a board of bankers. It's a cartel for the banks. So yeah, so all roads lead to banks making more money when the Fed adjusts things. All right, waiting for Powell to walk in. You know, the Fed is not like the White House, because the Fed is like, it looks like a school auditorium. It's really sad. You got these crappy chairs. They have a door with one of those, you know, it's just a wooden door. Here he comes. Way. It's a wooden door with one of those square boxy things on where the, you know, with the, where the thing opens and closes the door. Wow, he jumped right at that podium. Literally 2 seconds to get to the podium and talk.
Directly to the American people.
He's going to speak directly to us.
Inflation is much too high, and we understand the
Ooh.
hardship it is causing, and we're moving expeditiously to bring it back down.
Inflation is much too high.
We have both the tools we need and the results it will take to restore price stability on behalf of American families and businesses. The economy in the country has been through a lot over the past 2 years.
Bye-bye, Dow, bye-bye. We must bring inflation down. Keep saying it.
From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high.
Labor market extremely tight, inflation too high.
Today, we raised the interest rate by 0.5 percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate.
Ongoing increases appropriate.
In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy action.
We are reducing the balance sheet. The S&P just went red.
After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed,
He's saying that imports and inventories were the factors that hit the GDP, and he doesn't think that's gonna. He's calling it transitory, which is kind of a joke, you know.
In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions.
Wow, Dow's about to go red. Oh dear. Russell's red.
Labor supply remains subdued. Employers are having difficulties filling job openings and wages are rising at the fastest pace in many.
NASDAQ's down 70. Oh, S&P's green again.
Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production.
Aggregate demand is strong, bottlenecks and supplies are pushing inflation. S&P red again.
The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation.
Ukraine, blah, blah, blah. Nope, losing the Dow again.
Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy.
Oh no, 15, 14. Oh, negative. That was fast. Wow.
And further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels.
Oh, minus 25, minus 30. Stop. Oh my God, minus 40. 45. 55. Wow. Dudes, calm down. All right. Somebody hit the sell button. Anyway, so, all right, I think enough of that. Blah, 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 pow, pow, pow. Okay, so Okay, back to the broader picture. The key element here, where's my Philip, you know it's me. Where's my thing then? Stock charts. I guess I better go back to the main page. Default list. There we go. And the S&P, August 24th. No, I don't think so. March 15th. I really feel like I did a more updated one than that. Did I forget to save it? Oh, stupid. Okay. Anyway, still basically the same chart. I just did I fixed this. You know, these things are sort of drifting. Anyway, so here we are. Look, is that where we are? 4174? 4166 actually. Well, that's disturbing. You know, I pay for this. It's supposed to be up to date. Bloomberg says it's not. I don't know. Bloomberg says 73 now. All right, I guess it's close enough. I mean, for whatever. I'm not sure what kind of delay they got. Maybe Bloomberg's got the delay. Oh, Dow's up 75 now. We're saved. All right. Anyway, so everything's doing exactly what it's supposed to do. We bounced up. We're at the weak bounce line, but you see this stuff here? This the MACD line here, okay? This is showing that's pretty seriously oversold. And you see how this is? Generally, at the end of the oversold, not at the beginning of it, but at the end of the oversold, you see this, and you get a nice bounce off of that. Strong, should be a strong bounce at least coming off of that up an oversold condition, even if it's a weak, even if you're in a generally weakening trend. This kind of oversold is a lot, and it needs to be relieved. It's not that likely that you're going to go from something that oversold like this, like here, you know, like here. You're not likely to go from that oversold to even more oversold after that. They don't sort of double up. Here's one that doubled up. See how that's oversold, although obviously less. But this one was oversold, still had a bounce, but then went right back to being oversold again. Barely bounced up, but again, barely bounced is still bouncing. So here we are at that tail end of this oversold batch, and there should be quite a lot of pressure to push back up. It doesn't, these lines don't tend to stay this low for that long. You know, minus 75 is a lot. So you know, generally there should be relief of pressure. Once it gets back up to this area, then more selling can happen pretty easily. But it's just when you're down here, it just almost never going to go to minus 80. It's just so rare that it happens that way. It's just basically an indication of, you know, what percentage of people are selling and nobody's buying. So in theory, we should get to this strong bounce line at 43.20. It's not looking good though. Okay, because again, my problem that I found this morning, I was saying, what's the catalyst though? What's going to happen? This is the best catalyst we have. You know, the big companies already announced their earnings, so there's not a lot of strong big company earnings that are likely to come in that are going to change people's minds. Apple didn't change anybody's minds. I mean, if Apple can't do it, who can? So it's not likely that as we're moving into the smaller cap earnings and we're moving into the small and the micro earnings, and you know the small companies that are struggling. You know the Main Street company, the Russell companies are struggling, and they're going to announce a lot of crappy results, and we're already getting a lot of crappy results from the mid caps. You know, random companies can't handle the thing. Oh, I was going to go over that. I forgot. So the Fed is not giving us news that's going to change everybody's mind, and the earnings aren't going to improve. Putin's not going to stop the war in the near future. Although he could die, he's actually being operated. He's got in for cancer operation apparently now, so maybe he'll die. That would be actually well, you don't know who's going to take over, but in theory, if Putin dies, there's a possibility some new Russian leader can come in and stop the war. That would frankly, from the point of view of a Russian leader, it may show a little bit of weakness to start, but I think that weakness would be a relief to more people in Russia than it would be a problem for them. And I think coming in, stopping the aggression, saying you're going to have peace talks and sit down and discuss with the Ukraine instead of having a war would be a great international bridge building thing for a new leader to come in. So, and by the way, Russian leaders in the good old days used to die when they had a cold. So Putin's in for cancer treatment. Believe me, he could be dead tomorrow. Okay, he could die over the weekend very, very easily. This is, you know, every sniffle in Russia is a life and death situation when you're the leader. That's why you know, they're all big on projecting strength. They have to project strength no matter what. But in the old days, it was a joke because it was like, you know, Russians, they'd say he had a cold or he had the flu, and all of a sudden a new leader would come up, you know, a week later would step up. You wouldn't see the guy. You wonder what happened to him, and they would officially say, oh, he has a cold, and then some new guy shows up and goes, I'm now in charge of Russia. So that's pretty much how power was handled in the good old days back then. So this should still give us something, and the less it gives us, the worse it is. It's tragic that technically, because this is only a technical thing, but technically, if the technicals can't save us at all, the fundamentals sure as shit aren't going to. That's what I'm saying. And then we're talking about another major leg down. So we are not at all out of the woods. We'll see what the jobless is. The next big number now is the non-farm payroll on Friday. That's not going to really help though, okay? Because if there's a lot of people working, that's going to keep the Fed hiking more. They got to stop too many people. Too much job creation is inflationary. So that's number one. Number two is if not enough people are working, if the job creation drops a lot, and the ADP just showed a really crappy number compared to what was expected, about half. If the jobs are too low, then everybody starts worrying about the economy, which we already know is minus 1.4%. So we are in a very tough, tricky spot. See labor supply and demand coming to balance, blah, blah, blah. Okay, so Powell's not saying anything important. So we're in a tough, tricky spot, and the key is going to be, though, if we can get over the strong bounce line. I don't think we can. I don't see what fundamentally we can. And the problem is then the 50-day moving average took this. See the amount of, it's about halfway down from here, right? So it took 3 weeks to get from here to here, and it'll take another 2 or 3 weeks to get to here to cross under the strong bounce line. But if the 50-day crosses under the strong bounce line, that's like a double death cross. It's like a death cross here, death cross under the strong bounce line. By that time, if we're still, every day we spend under here is yanking the 200-day lower, right? And any day you're under the 200 yanks it lower, but significantly. And I think this morning we said right now under the week bounce line, you're pulling the 200-day moving average down 1.7 points per day. Oh, at the strong bounce line, you would probably half that. It'd probably be like about less than a little bit less than a point a day. But down here, you're pulling this thing down close to 2 points a day. And the 50 days obviously coming down even faster than that. Not 4 times faster because it's not as far up, so it's got a less of a formula. But either way, though, let's say this is 2 and this is 6 points a day. You know, if this is dropping 6 points a day and it's 72, and this line is 20, that's 59 points, 6 points a day. You have 10 days. So if we're under the week bounce, you have 10 days until the 50-day crosses below the strong bounce line, and which will make it very, very hard to break the strong bounce line. Make it incredible resistance. If you get to the strong bounce line, you probably have 20 days before it happens. So somewhere between 10 and 20 days, though, we're in that, or session. So it's 2 weeks and 4 weeks. So sometime in 2 weeks or 4 weeks, we are going to have a cross unless the S&P is above the strong bounce line. So it is life and death critical for the S&P on a technical standpoint to get back above the strong bounce line, because even at the strong bounce line, these guys are still heading lower, but not as fast. So this is right now, this is rapid decline. And rapid decline is going to make a very, very depressing chart shortly. And at the same time, this pressure, these numbers are going to come back, whether this goes up or not. The oversold condition only lasts. There's certain factors, but if you're oversold and you keep being oversold, it gets like this. It goes like that, and all of a sudden there's no pressure. Once you get back over here, you can easily go down lower, and that's what happens. So the selling will start again very quickly. So this is a sign of huge weakness, and of course we just had a sign of huge weakness, got to this level, had a bounce. Now we're back here. If we have another sign of huge weakness, you can bet everything on the fact that we're going to go down another, whatever this was, basically another 20%. So that's why it is critical that we get over that line. But what's going to get us over that line? I can't tell you. I don't see it. All right. Right now the Dow's up 300 points though. So something Powell was saying made him happy. Oh, Powell expects to see inflation flattening. 75 points is not something the FOC the Fed is actively considering. That's what he said. There you go. He's saying 75-point hikes are not on the table, and now the market is happy. And now the S&P is up 40 points, and the Nasdaq is up 60 points, and the Dow is up 300 points just based on that. Now, keep in mind what a weird game this is, because all the Fed officials last week were saying 75 points was on the table, and all of a sudden, Powell is saying, no way, not on the table. So that is now, so now it's a relief that something that was never going to happen is happening. And as I pointed out, their target was to be up at 2.5% at the end of the year. You don't need a 75-point hike to be up 2.5% by the end of the year, because we had 6 sessions to do it. So good. All right, that's where we are now. All right, so wow, now the Dow's up 400 points. Look how they were waiting for that, huh? All right, anyway, crazy. All right, so let's see if we refresh this, what it looks like. There you go. Look at that. So the question is, do we have enough gas to get over this? Still don't think so. But as long as we're up here, it'll slow this descent considerably. This has time to start picking up, and maybe we can get over that line and start making some progress. But if we fail the strong bounce line next week, we have a whole week. If we fail the strong bounce line next week, we're still in trouble. But like once we're past the week bounce line, forget my doom and gloom. You don't have to worry about the doom and gloom as long as we're over the week bounce line. But unless we get to the strong bounce line, we're just setting ourselves up to be weaker again. But this is as good as it gets. I mean, he just definitively said 75-point base rate hikes are not on the table. So we're keeping the hikes at a slow, steady pace. And that's going to make the market happy for now. Woo, out of voice. All right, guys. That was exciting. And we seem to be on a firm footing. I think we'll be fine. That means we're going to start probably adding some more longs. And that's what we do. First we hedge in case something bad happens. Then we add more longs. We took a nice cheap hedge yesterday. We added cash to the short-term portfolio. But now it's time to start making some of those adjustments in the long-term portfolio we've been wanting to do. So that'll be our job for the next couple of days, all right? Thanks for coming, everyone. And no webinar next week because I'm going to be at a conference in Vegas. And we'll do, and so a week from whenever, God knows what that is, 18th will be the next one, okay? I'll be back from Vegas on Monday, totally exhausted, but I'll be recovered by Wednesday, and we'll do a webinar then, all right? Take care, everybody. Thanks.